Hello. In this video, we're going to be going through an introduction and purpose of the statement of cash flows. When you're looking at a corporation, in order to project the company's profitability and risk, there's just answers that are needed to specific questions, such as what type of activities is the company investing in? How are these activities being financed? Is the company taking out loans? Are they issuing stock? Do they have cash, to finance these activities? Are sufficient plant assets being acquired to accommodate any future potential expansion? And how does the amount of cash generated from operations compare to net income over time? Meaning a company can have really high net income through sales, let's just say, but if they're not collecting on those sales, then those sales are kind of meaningless if you're not collecting the cash from those sales. And does the company have cash to pay out dividends to its shareholders? And what does the company do when they actually sell assets? What do they do with that cash? Does the company have cash to pay its debt when it becomes due? These are all types of questions that are needed to project a company's, risk and profitability in the future. And we get these answers through a statement called the statement of cash flows. When you think about a corporation, we have cash going in and out of the business all the time. A company will acquire and sell property equipment, any sales to customers, if it's on credit, then they have to collect the cash, or if it's cash, that's great. They have to invest in other securities or other companies, and they're selling their own stock or issuing debt. So when we look at the cash inflows and outflows, right, because sometimes we get cash in, but sometimes we pay cash out, those activities are provided on the statement of cash flows, and they are broken up into three components within the statement of cash flows. They're broken up into the operating, investing, and financing activities, all the cash activities for those sections. Here's what a statement of cash flows looks like. Before I get into it, so far in accounting, we've highly been focused on the balance sheet, the income statement, and the statement of shareholders' equity. This is the fourth statement that whenever you look at a company's 10K, you will always see a statement of cash flows. It is a required statement to be reported in the financials. So every company does this, and it's to show the investor or creditor or reader of the financials how the cash is coming in and out of the company. And here's how it's broken out. We have cash flows from operating activities, and there's two methods for the operating activities, but this is the indirect method. We're going to start with net income, and we make all these various adjustments, which we'll go into in future videos. And basically, it's all the ins and outs of cash flows related to their core operating activities. And then at the end, you have net cash flows from operating activities. So here we have $150. And think of this as your cash basis income statement almost. So from a cash basis, they have $150. Accrual basis, they have $120 from operating activities. Then we have cash flows from investing activities, and you list all the investing type of activities. Cash inflows or outflows, like if we purchase investments, short-term investments, that's a cash outflow. And if we sell equipment and we get money for it, then it's cash inflow. And then you sum all those up and you have your net cash from investing activities. And here you see how it's a negative. It is a cash outflow, a net cash outflow related to investing activities. Then you have your last piece of the statement of cash flows, which are the financing activities, inflows and outflows. And so if you repay note payable, right, then you're paying the bank back the loan. It's a cash outflow. Issuance of common stock means we are selling our own stock. So that would be cash inflow, right, because our shareholders are giving us cash. And so then you have all the cash inflows and outflows from financing activities to get to your net cash flow from financing activities. What you do next is you add up all the three activities and you have a net increase in cash right here for $100. It could also be a net decrease. And then you're going to take your beginning cash balance from your balance sheet and your ending cash balance, and the difference between your beginning and ending should be reconciled to the net increase or decrease in cash from your statement of cash flows. So when we're looking at cash, right, we're saying cash in, cash out. What do we mean? Cash is defined as currency and coins, the balances in our checking account, right? Any items that we deposit into these accounts, such as checks or money orders received from our customers. And so when we're looking at statement cash flows, it's cash, cash equivalents, and restricted cash. So we went over the definition of cash. Cash equivalents are short-term investments that we might have, but they are highly liquid. That means when we say highly liquid investments, that they're easily converted to cash and there's very little risk of losing cash. So these might be in money market funds, treasury bills, and commercial paper. These are very, very low risk. And when we say short term in this situation, we mean 3 months or less. Meaning the investments are only for a 3-month term, right? We're not putting into some long-term CD or making a long-term investment in another company. And if we needed to convert it into cash before those 3-month terms are up, we can, because they're easily converted into cash. Restricted cash is also part of what's considered total cash when we're talking about the statement of cash flows. And this refers to cash that's been restricted legally, or there's some sort of company policy that has to be used for a specific transaction. An example of that is sometimes loans, right? One of the requirements of getting the loan is that the company has to maintain a specific amount of cash on hand. And so that will be, restricted cash. They have it, but they're not using it. So let's talk about the statement of cash flows, because we're talking about that there's cash inflows and outflows from the operating, investing, and financing activities. What are those types of activities? Let's talk about the operating activities, the operating cash flows. These will be changes typically to your current assets and current liabilities. Let's talk about, let's say, inventory. And actually, let me take a step back. When you're looking at your operating cash flows, think of this as a cash basis income statement. So when you think about all your line items on your on your income statement, your revenue, your cost of goods sold, and like all your operating expenses, we want to report them on a cash basis. Okay, that's what we're doing in the operating activities section. So some of the cash inflows and outflows that a company might have is when they sell inventory, right? They receive cash for it. It's a cash inflow. When they purchase inventory, it's an outflow, right? When they're providing services or selling goods or paying for their operating expenses, those are cash inflows and outflows related to their operating activities. And then if they're collecting interest, so they're collecting interest because they have a notes receivable, then that would be interest income. So again, remember the operating section is kind of reporting an income statement on the cash basis. So if we have interest income, we have to report any interest that we receive in cash within the operating activities section. Or maybe they took out a loan and they're paying interest. Then those would be operating cash inflows and outflows. Taxes, always my favorite. If you get a tax refund or if you have to pay tax, that's a cash inflow or outflow. If a company is involved in a lawsuit, right, and they settle the lawsuit and they get cash for it, or settle a lawsuit and they have to pay out cash, unfortunately. And collecting dividends. I want you to keep this one in mind, because when we collect dividends, that means that we have an investment in another company and we are receiving dividends from that investment. Okay. All these items that we see right here, I want you to think about the income statement. When we sell inventory, right, we're hitting the cost of goods sold account. When we provide services or goods, actually, we're hitting our sales or revenue account. Collecting interest or paying interest, that's going to be interest income, interest expense. Same thing for taxes, tax, if I guess you have tax income or tax expense, right? If you're paying it out. And then if you're collecting a lawsuit, you're going to have a gain on the settlement lawsuit or a loss on the settlement lawsuit, all these things. And if you're collecting dividend from another company, from a company that you have investment in, it's going to be dividend income on the income statement. So I really want you to think about income statement items when you're thinking about your operating cash flows activities. Investing activities is you're going to look at your long-term assets and look at the change between your beginning and ending balances to see what occurred during the year related to investing and which part of those impacted cash. So if we have an investment, we can sell investment or purchase investment. And when that happens, what do we record? We debit investments and credit cash, assuming it's on our statement of cash flows. And typically it's a long-term investment, in which case it would be recorded in the long-term section of our balance sheet. It is possible to have a short-term investment, in which case it would be recorded in our current assets portion of the balance sheet. So just watch out for that. Another investing activity is if we buy or sell property, plant, and equipment. Again, let's think about when we purchase property, plant, we're going to debit property, right? And if we pay for it with cash, it's credit cash. It would go on the statement of cash flows. And where does that property reside within the balance sheet? As a long-term asset. Same thing with intangibles. If we purchase copyright or whatever it is, or a patent, or if we sell a patent, whatever it is, it's going to be the underlying asset for that transaction is going to reside in the long-term asset section and therefore an investing activity. Notes receivable. We might have a notes receivable if, let's just say, the company makes a loan to an employee for a large purchase. So let's just say the company lends X dollars to senior executive for a home relocation package. And in turn, the employee signs a 2-year note receivable at, 5% interest. That's going to be considered an investing activity. We're not paying them a salary, so it's not an operating activity. But we are creating a financial asset because we're going to record a note receivable and we're going to expect repayment and interest over time. We're investing our cash to earn a return. So therefore, it is going to be an investing activity. And then when we collect on that notes receivable, it's a cash inflow within the investing activity section. Let's talk about now financing cash flows. Now we're talking really items that hit the long-term liability and the equity section. And this is how we finance our company, right? With long-term debt and equity. So if we issue a note payable, or if we're repaying back, like the bank on a note payable, then that's considered a financing activity. So think about where does that notes payable, where would it reside on your balance sheet? It would reside as a long-term liability for us. Same thing with issuing bonds, right? So also means of raising capital. And so when we issue the bonds and then when we get repaid on the bonds, where does that bonds payable reside on our balance sheet? It's a long-term liability. So when whatever activity we have within our bonds payable account, and as long as it has a cash component to it, we're going to report on the statement of cash flows. And then the equity section, anything to do with our equity, with our own equity, where we issue our own stock or we purchase our own stock, like treasury stock, or we retire that stock. Where does that stock reside on our balance sheet? It's in the equity section, and therefore it is a financing activity. And finally, when we pay our shareholders dividends, that is also a financing activity. Think about this journal entry. When we paid dividends, we would debit retained earnings and credit cash. As long as we're kind of crediting cash, then that's a financing activity. And where does the retained earnings reside on our balance sheet? Within our equity section. I want to point out one thing. When we pay dividends on our own stock, it is a financing activity. However, when we collect dividends, because we have an investment in another company, think about this. That dividend is recorded on our books as dividend income, which is an income statement item, and it is considered to be an operating activity. So that's really important to note that when we have collecting dividend is an operating cash inflow. When we pay dividends on our own stock, then it's a financing cash outflow. Now we're going to go through some transactions and identify them. Is this an operating, investing, or financing activity? And is it a cash inflow or cash outflow? I also want to briefly touch on non-cash transactions. Non-cash transactions have to be reported on the balance sheet on the statement of cash flows as well. I've popped back over to our statement of cash flows that we saw in the beginning of the video. And this is like the second part of it, where we have the cash flows from investing activities and financing activities. And then we have our net increase in cash, and we compare it to our beginning and ending, and that net increase should be the difference. I want to point out this bottom section right here, where we discuss non-cash investing and financing activities. And this one says, purchase land of $50 by issuing a 12% 5-year note. When you have inflow and outflow, not of cash, but impact and a transaction that's impacting a financing and investing activity, right? We have to disclose that in our statement of cash flows as long as it's material. So here, we'll think of our journal entry. We would debit land and we would credit note payable, right? So land is a long-term asset in our investing section, and our note payable is a long-term liability under the financing section. So this is just like all when we exchange investing transaction with financing transactions that don't involve cash, we report it also on the statement of cash flows, but in its own separate little section at the end. And then finally, last piece I want to point out about the non-cash investing and financing. It doesn't have to be a transaction that's between the two different types of activities. It could be within its own. So highly unlikely, but let's just say we exchange one building with another, right? I sell you my building and you're going to give me your building in exchange. So there's no cash, but my building, a sale of a building is considered investing activity as well as a purchase. So that would be recorded as a non-cash investing activity. Okay, so let's start and you'll get the hang of this. Purchase of equipment, is that operating, investing, or financing? Well, equipment is going to be in our long-term assets, so that's going to be investing. And when we purchase, we have a cash outflow. When we have exchange of plant assets for fleet of trucks, so we're exchanging one asset for another, that's going to be a non-cash transaction. Redemption or payoff of a loan, right? So that's when we pay off a loan, it's going to be a cash outflow, because think of it as paying cash to the bank. And our loan is going to be on a long-term liability, so that's going to be a financing activity. Sale of equipment. Well, the same thing as purchase of equipment. It's going to be investing activity, and the sale is a cash inflow, because when we sell the equipment, we get cash for it. Issuance of common stock. Issuance means sale. And so sale of our own common stock, our common, that's a way of us financing or raising capital for our company. Common stock is in the equity section, so it's a financing inflow. Dividend revenue from investments. Dividend revenue is, even though it's an investment, right? And so you're like, oh, investment means investing activity. This is a tricky one because the dividend revenue is on our income statement, and we have to convert our income statement into a cash basis income statement. And so that's going to be actually an operating inflow. Payment of dividend. So when we pay out our dividend on our own stock, that's part of our equity section, right? Debit retained earnings, credit cash. And so that's going to be a financing activity. So that's a financing outflow. When we issue bonds for a warehouse, we issue bonds to buy a warehouse, right? That's going to be just a non-cash transaction. So no inflow or outflow of cash, just non-cash that we have to disclose. Issue bonds for cash. That means we're selling bonds and receiving cash. So it's a cash inflow. The bonds now is a bonds payable for us. So it's a long-term liability and therefore a financing inflow. When we buy bonds for cash, that means we're buying bonds from a different corporation, right? We paid them cash, so it's a cash outflow. We're buying their bonds, so we have a bonds receivable, and that's going to be a long-term asset, right? So that's an investing activity. So just be careful. When we issue our own bonds, it's a financing activity. When we buy bonds from another company, right, that means we're investing in that other company, and this is a bonds receivable on our balance sheet, and it's investing activity. Purchase of treasury stock. This is when we buy back our own stock. So that's going to be cash outflow because we have to pay for it, and that's on our equity section, and therefore a financing activity. Interest paid on a note or bond payable. So now we have a bond that we have issued, right? This bond that we issue is a financing activity initially. When we pay the interest to the bond holder, we have to debit interest expense, and that's actually just part of our operating activity. It's going to be operating cash out. I just wanted to kind of go over all these different types of transactions so you can get an idea of which part of the statement of cash flows they go. It's really important to know this because this is the foundation of the statement of cash flows. Again, I just want to reiterate that these are all cash transactions. So we have to dissect each of our accounts to see what component of those accounts involved cash. And that will be all the future videos related to this chapter.